Hi there, and welcome to the second part of this lecture on the equities market. In this lecture, we're going to cover the various valuation techniques for equities. As previous lectures, the slides are rather readable. Therefore, following this recording, do go back through the slides and follow the mathematics for yourself to fully understand what has went on and which formulas were used. There's also a spreadsheet on Blackboard which goes through the mathematics in Excel if you'd like to look at that as well. Whenever we value equities, traditionally it's known as discounting future cash flows. In other words, a company today is worth all future cash flows discounted to today. But it's quite difficult with equities because we don't know what the capital gain is going to be or the potential future cash flow when we sell the shares. And also, dividends are not mandatory, and some companies don't even pay dividends. So when we're valuing equities, which is the present value of all future cash flows, then it can become tricky if we don't know the share price and we don't know the dividends in the future. So essentially, equity valuations is a forecast. We have to forecast future cash flows, discount them to today, using certain discount factors, and so on. But there's also a range of market factors that we need to potentially forecast and incorporate into these valuation techniques. So how do we know capital growth? It could vary on many things. Market risk, which will encapsulate geopolitical issues, regional performance, foreign exchange. And then when we get down to industry level, certain sectors have different characteristics and certain companies will have their own idiosyncratic risk. In other words, the risk of the individual. And ultimately, equities, shares, their price is determined via supply and demand. Obviously, supply being fixed, a certain number of shares available, but obviously demand differs depending on sentiment and news. And we'll cover this in the final part of the lecture when we talk about stock market efficiency. So the three techniques we're going to go through today are asset-based valuations, dividend-based valuations, and earning-based valuations. Essentially, we're trying to work out the intrinsic value of a company, or we're trying to work out the theoretical value of the company based on said calculation of certain forecast. How much should the company be worth today? Discount all future cash flows back to today. And then we're simply comparing the intrinsic value, the theoretical value calculated, with the actual share price to decide whether or not to invest. Now, the classic question is, which one of these techniques is better? Well, quite frankly, I can't give you an answer. Which one do you use? Again, technique can't give you an answer for that. Because in practice, the best one is the one that gives you the best answer. It depends what you're using it for. The likes of earning-based valuations are very good for comparisons, to compare between companies in a certain sector. But when we do valuation on asset-based and dividend-based, then the numbers we use vary depending on the discount, the required rate of return, and so on. So you as an investor, you're going to use the method that gives you the best answer. So I'll put it to you, if you're a company trying to buy another company in the form of merger and acquisition, you're going to work out the value of this other company you want to buy. You might do all techniques. Which one are you going to use? Quite simply, you're going to use the number that gives you the lowest value, aren't you? You're going to do all these techniques and go, well, actually, this one gives me the lowest cost, therefore I'm going to use this one as my purchase price. On the flip side, if you're the company, then you probably want to say, well, I'm actually valued at this, and you want to use the higher price. So in practice, you're essentially going to use the technique that gives you the best answer for whatever reason you are doing the valuation in the first place. And like I said, this could be just to invest in the company, it could be in the merger and acquisition process, but it even could be on loan applications. The banks may ask, what is your company valued at? Then of course you're going to have to go through the valuation techniques like this. So let's look at the first technique, the asset-based valuation. This is the most simple calculation to work out, Essentially, you're valuing the company based on the assets it owns or has access to. So the example being an investment trust. An investment trust is basically a company that invests in other companies. So the value of the investment trust is simply the value of all of its investments. So an investment trust will own equity and shares in other companies. It will say which holdings it has. Therefore, you can work out the actual market price of all its holdings, and then you can very quickly work out how much this company is actually worth. Same with property companies. You know which properties it owns. You know the value of their assets. Therefore, you can appropriately value how much the company's worth. In certain sectors, the likes of the mining sector, then you know how much reserves that this mining company has access to. If it owns that one mine, then you can forecast how much that mine is worth or how much assets it has in that mine. Therefore, you can use that to value the company. And if you want to put it into a mathematical equation, then the value of the company is the market value of all its assets minus the market value of any liabilities it has, the likes of loans, for instance. So basically, its assets minus its liabilities is the actual value. However, there is some potential issues when it comes to asset-based evaluations. This is specifically relating to intangible assets. So if the company has a very good brand, how on earth do you value that as an asset? It's intangible. In the case of quick fire sales, then when the markets are depressed and everyone's selling, for instance, then assets across the board drop. Therefore, if the assets of the company's balance sheet drops, then the overall value of the company drops. And in quick fire sales, this is quite hard to judge because assets do drop down quite significantly, probably as an overreaction. Therefore, when you do asset-based valuation, then it might be a lot lower than what the company's actually worth. And there's also a big issue when it comes to the unicorns, which I mentioned in the last part. These companies technically don't have any assets. Well, not all of them. They have a platform, or they outsource, they have contractors. Do they have any physical assets? Take Uber as your example. What is Uber's actual assets? Can you add all them assets up? Because when technically the drivers, are they an asset of Uber, or are they a supplier of Uber, and so on. You've got Airbnb, Slack. Again, this is a company that has software which is an alternative to Microsoft Teams. What is its physical assets? I mentioned it previously. These unicorns didn't actually make any profit, certainly when they're listed. Therefore, how can you potentially value them? They don't have any assets or any profits or any claims to profits. And they're also a problem for the next valuation technique when we're talking about dividend-based valuations, given that they haven't paid any dividends or that they are actually profitable. So the second technique is based on cash flows. And this is a concept of you're trying to work out the intrinsic value of the company based on the present value of all future cash flows. So let's do a mathematical example for this one. And we're going to start with the assumption that the share price or the market value is equal to the present value of all expected cash flows, discounted at a market required rate of return. When we talk about required rate of return, then we're also potentially talking about the cost of equity and the capital asset pricing model, which we'll use shortly, which is another formula. So we have an example here. So assume that the dividends are constant. If you have a dividend per share of 25p and a cost of equity, as I said, required rate of return, CAPM, of 15%, then the share price of this company should be 25 divided by 15%, thus being £1.66, 0.67. However, we've assumed that the dividends are constant there, and this really isn't a good assumption to have. when we talked about the first part, there was a level of growth in the organisation, potentially reinvesting profits and so on. Over time, you would expect dividends to grow as a firm grows. So we can't assume that dividends should stay the same. Obviously, in this example, we haven't got any track record. We can't look back to look forward to see what the track record is. So in this very simple example, we'll just show you that there is a level of growth rate because the company's improving, it's getting bigger, more profitable. But also, think about inflation. Shareholders want to be compensated. They want their dividends to grow above inflation as well, due to the time value of money. So again, we can build on this equation, and we can build on it by incorporating a certain growth rate. So again, we'll use the same example. So dividend per share, again, we'll keep it at 25p. But we'll incorporate again the cost of capital or required rate of return at 15. But this time we're going to minus the growth rate from this. And because we've incorporated this growth rate, then this has really changed the discount factor that we use. So now we've got 25p divided by 5%, which equals 500. So the share price, in this case, the previous intrinsic value was 166.67. With the incorporation of growth rate, the discount is much larger, because obviously it was 0 before, therefore the share price is much higher at 500. But you're probably thinking, why haven't we taken into account the actual selling price of the share? Because we noted before that the equity value is based on all future cash flows discounted to today, and one of them cash flows will be the selling price. Well, actually, we have, and this is because the required rate of return and the addition of the growth rate as the discount factor is trying to incorporate the future selling. Because if we look at the statement here, then the price at any point in the future is simply the dividends per share from that point to infinity divided by the required rate of return or cost of capital. Thus, this formula does actually include the potential cash flow from the future share price at the point of selling. And effectively, the growth rate is used twice because that is also incorporated within the cost of capital. Let me show you one of the more famous formulas, and this is known as the Gordon growth model. And this is used when we try to work out the share price or the intrinsic value. So this being P0 is the share price today. And in this formula, we have D1, which is the previous dividend plus the growth rate. In other words, D1 is looking for the next dividend payment. And this D1 is a forecast. So we're forecasting the next dividend by using the previous dividend times by a dividend growth rate. And then we're going to divide the next dividend, a forecasted dividend, we're going to divide that by the cost of capital, or the required rate of return, or CAPM. We're going to divide it by that minus, again, the growth rate. So as I know, it's incorporated twice. But this formula becomes a problem when the cost of capital, or the required rate of return, is smaller than the growth rate. Because if the bottom half of this formula is negative, then that would say today's share price is negative. Thus, a problem of this model. So let's build onto this formula to actually show you what K is. So K, I've always said, is the cost of capital, or the required rate of return, or the capital asset pricing model. Then this is the formula for K, or this is CAPM. You have the risk-free rate of return, which typically is UK government debt rate. You could use the 3-month T-bill rate, or theory could say it could be a 10-year bond, plus the market rate of return, the actual return or the required return, minus, again, the risk-free rate. And this is times by something called beta. And beta is a comparison figure of this individual company compared to its market. In simple terms, if beta is 1, then this company, its price, moves at the same rate as the market. If the beta in this case is 0.9, then the share price is not as volatile as the market and it will move slightly less. If the market moves by 1, this company will move by 0.9. If the beta was 2, if the market moved by 1, this company share price would move by 2. So it's kind of a volatility measure, comparing the company with the market. If we look at how that's actually calculated, for any mathematicians in the room, then beta is the slope of the line here. You've got Greg's on the y-axis, you've got the FTSE 250 on the x-axis. I've plotted their returns. You put in the line of best fit, and the slope of the line is beta. But if we go back to this example, you've got company A has paid a dividend per share last year of 20 pence. It's shown a constant growth of 8% over its lifetime, and the market rate of return, so the return of the market the company's on, is 15%. We've got the risk-free rate, so we'll say the government T-bill at 3%, and beta being 0.9. Because we're trying to work out the intrinsic value here using CAPM, the question is, should we invest in this company at 375 pence? So we need to use the combination of the formulas now. So if we put this data on the slide into the capital asset pricing model, or the cost of capital formula, then put it in there, and then simply we get a cost of capital of 13.8%. So now that we've worked out the cost of capital, we need to plug that back into the previous formula. And if we do that, we've got the dividend, or the next dividend, so we've got the last dividend plus the growth, times by the growth rate to work out the next dividend. And we've got the 13.8 we've just calculated minus the growth rate. So if we work that out, then the intrinsic value of this company is 372.41. And the question said, should we invest in this company if the market price at the minute is 375? Well, of course not. You wouldn't invest in this company based on this valuation technique because we valued it slightly lower than what the market price is. Therefore, we would be paying too much for it if we paid 375 pence. But let's look at the same company again and see how important this growth rate in dividend potentially impacts the intrinsic value. So keeping everything else equal, but we're just going to tweak the growth rate up by 1%. So the growth rate is now 9. If we follow the example through with the maths, again, the cost of capital, CAPM formula, doesn't change because the growth rate is not here. So it's still 13.8. The growth rate is now incorporated in this model, the Gordon growth model. Again, when we try to work out the next dividend payment, we've increased the growth rate here, which increases the top half of the formula. It also lowers the bottom half of the formula because the growth rate's gone up. We've minus that from the cost of capital. So it increases the top half, it lowers the bottom half, which substantially increases the intrinsic value. So before we calculated the intrinsic value at 372 pence 41, but with this change in growth rate, the intrinsic value is 454.17. So this would suggest that the company is severely undervalued in the market. Do go ahead and look at some readings regarding these formulas, so the Gordon growth and the capital asset pricing model, because there's various different issues with the models. Just as an example, the capital asset pricing model has at least 10 assumptions and limitations. Quick assumption is that everyone has the same information, there's no tax involved, that sort of thing. So they're really in isolation there. But if we just think about the Gordon growth model, what happens if the company doesn't pay any dividends? we've predicted a growth rate. If the company hasn't got a track record, then the growth rate of the next dividend payment is just potentially predicted or assumed. Of course, we can assume no growth, but again, should we do that, given that companies are meant to kind of prosper, increase their profits and increase dividends? In the case of market stress, lack of market liquidity, then the predictions of market return and growth rates will drop, and we can't really forecast that. So there's a range of different issues of the capital asset price model and the golden growth model for working out an intrinsic value. But in your textbook, you can read the various different limitations and assumptions of each. And the last valuation technique is the earnings-based technique. And the most common earnings technique here is the PE ratio. And this examines the company's earnings, its net profit, compared to its share price. And this PE ratio is actually a little bit meaningless in isolation. The purpose of an earnings-based or PE is to compare it. So you just simply compare the likes of this PE ratio with its peers. So you look at a PE ratio from one company compared to another. Pure comparison basis. And typically you compare it with companies in the same country, same sector, and so on, to say what's that company's earnings worth relative to its share price. Is it better or worse than its peer? That's the best use of a PE ratio. Given a PE ratio in isolation is not very good. Of course, you can compare PE from this year to last year because they're typically recorded in annual reports, and that is a good way of kind of comparison ratios of growth, I guess. But from an investment point of view, you must compare it with a peer, otherwise it's pretty irrelevant. Let's show you how this works, but to start with, we're going to use the same capital asset pricing and dividend discount golden growth model to kind of predict the share price and the earnings. So again, this formula underneath is the CAPM model, but for this example, we're assuming the company is the same as the market from the point of beta, so beta being 1. The market return is 15, the risk-free at 5%. But notice the next assumption. The last dividend paid represented 50% of company's earnings and was 12 pence per share. That's useful because we need to think about the dividend payment. How much of the profit do you actually pay out? How much of the earning do you pay out in dividends? As I mentioned earlier, if you're at the start and growth phase, your payout ratio of how much dividend you're going to give relative to your earnings is going to be lower because you want to reinvest in your business. When you're more mature, you're probably more likely to pay out more dividends. So that's kind of the key bit of information there. So the last dividend paid out represented 50% of the company's earnings, and this was 12 pence per share. And we're assuming a growth rate again of 8%. So we'll do the capital asset pricing model. Then because of this, we worked out the cost of capital, CAPM, being 15%. If we then plug that into the golden growth model, then this will work out the intrinsic value of this company being 185 pence. Then the next formula is where we incorporate the earnings per share. This formula is the dividend divided by 1 plus the retention ratio. And that retention ratio is how much of the profit was paid out in dividend. In this case, we've said the dividend represents 50% of earnings. So we've got the last dividend, which was 12p. We're going to times that by the growth rate. So the top half of the formula over here is working out the next dividend payment. We're going to divide that by the retention, 1 minus the retention ratio. So essentially the next dividend divided by retention says the earning for this company, earning per share, is 25.92. So we've got the intrinsic value, the share price on this side. We've got the earnings on this side. Thus, if we work out the PE ratio, the formula is PE, price divided by earnings. Therefore, the PE ratio of this company is 7.14. And as we said before, what on earth does 7.14 actually mean? Remember, we have to compare this with something. If a competitor company has a PE ratio of 10, then this means our company is probably undervalued relative to its competitor. The price being charged for earnings generated is too little. It's lower than 10. But if we look at the industry, and the industry average PE ratio is 5.5, then technically our company is probably overvalued. The price that's being charged for every little bit of earning is much greater. Another way of looking at this is investors are willing to pay £7.14 for £1 of earnings. That's another way of looking at the PE ratio, and that's how the textbooks might define it. But remember, it's purely for comparison reasons. But if we assume some sort of market rationality, that the markets act rationally, not irrationally, how can this be the case? Now we need to go back to our example. Much of the information is known or it is observed. And if we go back earlier, when we shown that a 1% in the growth rate made a massive difference in intrinsic value, this is the information we need to look at and obviously assess the impact. So if we just do another example where we change the growth rate, so what I've done here is I've changed the growth rate, which again we assumed or calculated. I've changed that up to 10, again big difference. You can see the share price has changed drastically from before. So the share price before was 185, it's gone up to 264. The earnings, however, hasn't changed much. The earnings per share before was 25.92, but when we change the growth rate, it doesn't really impact the earnings that much. It just makes the next dividend payment go up slightly, but retention ratio has stayed the same. Therefore, the earnings per share has only increased slightly. Therefore, if you do the PE ratio now, the PE ratio is 10, and before the PE ratio was 7.14. Therefore, as growth increases, the PE ratio increases, and as growth decreases, the PE ratio decreases. But if we think in practicalities, 1 year a company might have a decent year, therefore it pays out a dividend much higher than the previous year, which would show a massive increase in growth rate, which could alter the intrinsic value very drastically. So then, as an investor, you could probably think, oh, well, this company is growing much rapidly. Great, I'm willing to pay more for every bit of earnings. But it could also mean that the market's quite irrational, or it could also mean that these models are not very good. And just to have a quick look on Bloomberg, if we go on to Bloomberg and go on to the security description page, what you will get is information on the current PE ratio, potentially an estimated PE ratio, and we'll also get the likes of the dividend yield, so we can kind of work out the net growth in dividend. So we can potentially use historic trends, historic data to plug into these models to try and predict the actual current share price and so on. And what you can see here is the kind of textbook definitions of the likes of PE and the dividend yield ratio. And that concludes the second part of this lecture.